Most traders think their exits are a discipline problem. Take profit too early, hold a loser too long. Just tighten up, follow your rules, be more patient. That's the advice you've heard 1,000 times, in 1,000 different comment sections, from 1,000 different accounts, with a Lambo in the profile picture. It's also wrong. Because the traders bleeding out small wins and giant losses aren't undisciplined, many of them are meticulous. They journal. They backtest. They can quote their own win rate to 2 decimal places, and they still watch a winner get cut at a fraction of its actual move, and a loser bleed for hours past the point where they knew, somewhere underneath the hope, that it should have ended. That's not a willpower failure. That's your brain doing exactly what it's designed to do. Treating a loss as roughly twice as painful as an equivalent gain feels good, and reacting accordingly, trade after trade, whether you consciously agree with it or not. By the end of this video, you'll understand the actual mechanism behind that pattern, the exact moments in a trade where it takes over, and, more usefully, how to build a process that makes the right exit automatic, so you're not relying on willpower you don't actually have on your worst day. This isn't going to be another list of generic reminders to stay disciplined. It's the actual wiring underneath the behavior, and the specific, practical adjustments that work with that wiring, instead of pretending you can just think your way past it. Now, everything covered earlier in this video, the pullback trap, the round number illusion, the mechanical stop, that's the technical fix. That's the what to do differently on the chart layer, and it matters. But if you stop there, you're going to hit a wall, and most traders do exactly that. They print out the rules, tape them to the monitor, and break every single one of them the first time a real position moves against them at real size. Because knowing the rule and being able to execute the rule under live pressure are 2 completely different skills, built by 2 completely different processes. Reading a checklist trains your knowledge. It does almost nothing for your execution. So let's go one level deeper, into the part almost nobody talks about in trading content, because it doesn't sound like trading advice at all. Why can the same trader know exactly what to do, write it down, agree with it completely in a calm moment on a Sunday, and still not do it on a Tuesday afternoon with real money on the line? Here's the first mistake most people make when they try to fix their trading psychology. They go find a strategy that worked for someone else. Some scalper on YouTube posting 5-minute charts and stacked green candles, some swing trader with a big account screenshot and a course to sell, and they try to force themselves into that exact mold. Same entries, same time frame, same rules, copied line for line. And then they wonder why it feels like fighting their own nature every single day, why they can't stick with it past a few weeks even when the backtest looked great. It's because it is a fight. Your trading style has to be a direct extension of traits you already have, not a personality you're borrowing off someone else's channel. Think about it in plain terms. If you're someone who's naturally impatient, who processes information fast, who gets bored sitting still in other parts of your life too, forcing yourself into slow, 4-hour chart swing trading is going to feel like wearing someone else's shoes 2 sizes too small. You'll break your own rules constantly, not from a lack of discipline, but because the system itself is structurally fighting who you are every time you sit down at the screen. On the other hand, if you're a deep, methodical thinker, the kind of person who researches a mattress for 3 weeks before buying it, who needs to feel like they've turned a decision over from every angle, scalping is going to shred you. You won't have processed the setup before the candle's already closed. Every entry will feel rushed and half-informed, because for you, it is. So take an honest inventory, the same kind you'd take before choosing a career, not just a strategy. Are you naturally curious? The type who likes digging into why something works, rather than just that it works? Do you already show strong self-control in other areas of your life? Diet, spending, how you handle conflict? Are you entrepreneurial, comfortable building your own systems from scratch, rather than following someone else's playbook? Those aren't personality quiz questions for fun. They're the raw material your trading approach should be built out of. A fast processor with genuinely high risk tolerance might thrive scalping 5-minute charts, reading order flow in real time, comfortable making 20 decisions an hour. A deep analyst who likes sitting with a decision, who feels most confident after doing the homework, might do far better running a small number of high-conviction swing positions a month and would burn out or blow up trying to scalp. Neither style is superior in the abstract. The strategy itself isn't the edge. The fit between the strategy and who you actually are, that's the edge. And it's one almost nobody selling a course is going to tell you to look for, because buy my exact system is a much easier pitch than go figure out who you are first. Think about two traders who both learn the exact same 3 traps we covered earlier in this video: the pullback, the round number, the false hope candle. One of them is a naturally patient, detail-oriented person who already spends hours on unrelated hobbies getting small technical details right. For that trader, waiting calmly for a low-volume retest to confirm before adding size isn't a hardship at all. It's basically an extension of how they already approach everything else in life. The other trader is someone who's naturally decisive, who thrives on quick feedback loops, who gets restless waiting on anything. Force that second trader into the same slow confirmation process, and you're not building discipline, you're building resentment that eventually erupts into rule-breaking. The fix for Trader 2 isn't more patience training. It's a faster feedback style, smaller, quicker setups with tighter invalidation, that channels the same decisiveness that makes them impatient into something the market can actually reward, instead of fighting it every single session until it wins. Now let's talk about the moment your plan actually breaks down. Not in theory, but live, mid-trade, when the fear or the hope is loudest, and your rational brain has essentially left the building. Most trading psychology advice tells you to journal it. Write down what you're feeling in the moment, reflect on it later, be gentle with yourself, process it after the session closes. And that's fine, genuinely useful even, for after the fact. But in the actual heat of the moment, when you're staring at a losing position and your brain is screaming that it'll come back, calm, reflective journaling does almost nothing. You cannot outthink a limbic system that's already running the show. You need something with enough force to actually interrupt the pattern in real time, not analyze it 3 hours later over coffee. So here's the harder, more aggressive version of the fix. When you catch that self-sabotaging voice mid-trade, just hold a little longer. You'll look stupid if you cut this now. One more chance, it always comes back. Don't calmly reason with it. Reasoning is exactly the tool that's already failing you in that moment, because the voice isn't reasonable, it's emotional, and you can't out-argue an emotion with logic delivered in the same calm tone that just lost. Get angry at it instead. Picture that voice as coming from someone else entirely, someone you don't respect, someone deliberately feeding you bad advice for their own benefit, and then reject it, forcefully, out loud if you have to, in the moment it appears. Tell it no. This isn't about being polite or gentle with your own psychology. It's about generating enough emotional charge, on purpose, to override the emotional charge that's already hijacking your decision-making. Quiet, rational self-talk rarely wins against fear or hope in real time, because fear and hope were never rational forces to begin with. They're older, faster, and louder than your prefrontal cortex. But intensity can interrupt intensity. Use it as a circuit breaker in the exact moment you need one, not as a permanent personality you wear all day. Picture the actual moment this applies to. You're down 2% on a position, it's ticking against your predefined stop, and a small voice says, "Just give it another 10 minutes, it always comes back around this level." That voice is quiet, reasonable sounding, almost persuasive. That's exactly what makes it dangerous. In that moment, don't negotiate with it as if it were a colleague raising a fair point. Recognize it immediately for what it is: a survival instinct, thousands of years old, that has absolutely no idea what a stop-loss order is and doesn't care about your account. Some traders find it useful to literally name that voice, give it a name that isn't their own, so that when it shows up mid-trade, the response isn't, "I'm having second thoughts." It's, "There's that voice again, and it's wrong." That small act of separation, treating the impulse as something outside yourself rather than a genuine part of your judgment, makes it dramatically easier to reject it forcefully instead of getting pulled into a slow, exhausting internal debate while the trade keeps bleeding. If this is the first time you're hearing your trading problems explained through actual mechanics instead of vague, "just be disciplined" advice, That's what this channel does every single week. We take the stuff that sounds like common sense and show you the actual wiring underneath it. Hit subscribe, tap the bell so you don't miss the next one, and if this is helping you see your own trading a little differently already, a like genuinely helps this reach more traders stuck in the exact same loop you were in 20 minutes ago. Now, back to the psychology, because the next part might be the single most important reframe in this entire video. Most traders journal like they're building a court case against themselves. Every entry is a list of mistakes, what they did wrong, where they broke a rule, what it cost them in dollars. And it feels productive while you're doing it, because it feels honest, almost like penance. But stop and think about what that actually trains your brain to do over months of repetition. It trains you to associate the act of trading with an incoming verdict, to walk into every single session already braced for another entry in the mistakes column before you've even placed a trade. No high performer in any serious field builds confidence that way, and if you saw it happening to someone else, you'd recognize it immediately as a bad idea. You wouldn't tell a kid learning piano to only ever point out the wrong notes and never once mention the passage they nailed. Yet that's exactly the journaling structure most traders run themselves through, day after day, for years. So flip the practice completely. At the end of every session, win, loss, doesn't matter, green day or red day, write down one specific thing you did correctly. Not a vague feeling, not, I felt good today, or, I traded well. Something concrete and specific enough that you could hand it to another trader and they'd know exactly what you mean. You sized the position correctly, even though the trade ended up losing. You respected your structural stop instead of moving it 3 times as price approached it. You skipped a setup that didn't meet your own criteria, even though you were bored and wanted action. And that restraint alone is worth writing down. Then define exactly how you're going to repeat that specific behavior tomorrow. This isn't positivity for its own sake, and it isn't about protecting your feelings. It's reverse engineering your own competence, so you actually know, in specific, repeatable, almost mechanical terms, what your good decisions look like from the inside, instead of only knowing, in vivid, painful detail, what your bad ones felt like. Picture what this actually looks like written down, not good session today, which tells you nothing 3 weeks from now. Something like, price approached the round number I identified before entry. Old me would have taken profit right there out of fear. Today I checked the chart, saw no real structural resistance at that level, held the position, and let the trailing stop do its job instead of my emotions. That single entry does 2 things at once. It proves to you, in writing, that the round number trap is something you can actually recognize and resist in real time, not just understand intellectually. And it gives you a specific, concrete instruction for tomorrow. Keep checking structure before you let a clean number talk you out of a good trade. Do that consistently, and within a few weeks, you'll have a written record of your own strengths that's far more persuasive, in the moment it matters, than any amount of general self-belief. If you're not already tracking execution quality separately from your P&L, this is exactly where that habit needs to start. Most traders have months, sometimes years of trade history, and zero record of whether their actual process improved over that time. They can tell you their win rate, but not whether they're making better decisions. I put together the simple journal structure I use for this, built around the 2 columns that matter most: what you did well, and how you're going to repeat it tomorrow. It's linked in the description if you'd rather start from that structure than build your own from scratch. Once you have that running list of specific good behaviors, the next question is how you actually make them automatic, how they stop being something you have to consciously remember under pressure and start being something you just do without thinking, the way an experienced driver doesn't consciously think about checking mirrors. And this is exactly where almost everyone underestimates what real change actually takes. They read one article about cutting losers early, they execute it perfectly for 4 days straight, they feel like a different trader, they slip once on day 5 under a stressful session, and they conclude the whole idea doesn't work for someone like them. That's not a failed idea. That's an under-repeated one, abandoned right around the point where most meaningful change actually starts to show up. Real behavior change in trading needs sustained, unglamorous, Often boring repetition, the same single adjustment, tracked deliberately for roughly 90 consecutive days. Not 90 days of trying to overhaul everything about how you trade at once, which is a near-guaranteed way to burn out by week 2. One single thing. Maybe it's your exit timing specifically. Maybe it's position sizing, and nothing else. You pick that one lever. You track it explicitly in your journal every single day whether it went well or not, and you stay on it past the point where it starts to feel hard again. Past the point where the old pattern tries to quietly creep back in the first time you hit a losing streak or a stressful week. Somewhere in that 90-day window, usually not immediately, usually somewhere in the murky middle where it doesn't feel like it's working yet, the new behavior stops requiring conscious willpower and starts just being what you do, without having to decide it in the moment. That's the actual target. Not motivation, which is unreliable by design. Not more information, which you probably already have plenty of. Repetition, sustained long enough that the correct action becomes the default one, even on your worst, most emotionally loaded trading day of the month. Here's roughly how that plays out for someone who picks exit timing as their single lever. Weeks 1 and 2 feel almost artificially easy, because motivation is still high and the novelty hasn't worn off yet. This is the part everyone gets right and mistakes for having fixed the problem. Weeks 3 through 5 are where it actually gets tested, usually because a losing streak or a stressful week outside of trading shows up and the old pattern tries to reassert itself under pressure, exactly when it's hardest to stick to the plan. Traders who quit almost always quit somewhere in that window, right before the behavior would have started to take hold, and they walk away concluding the method doesn't work for them. The ones who push through that middle stretch, still tracking the same single metric every day even when it's boring and unglamorous, usually notice sometime around week 7 or 8 that the correct exit isn't something they're consciously forcing anymore. It's just what they do, the same way an experienced driver doesn't consciously decide to check a mirror before changing lanes. Here's something almost nobody in trading education wants to say out loud, mostly because it doesn't sound like trading advice at all, and it's hard to sell a course around it. How you're living outside the market directly determines how you trade inside it. If trading is the only place in your life where you feel competent, the only real source of excitement in your week, the only thing giving your day a sense of purpose or momentum, then every single trade ends up carrying an emotional weight it was never supposed to carry. A loss doesn't just cost you money in that scenario. It threatens the one structure holding your mood, your identity, and your sense of progress together, all at once. That's an almost impossible position to trade from with any real clarity, no matter how good your technical rules are on paper. The traders who manage risk the most calmly, the ones who can take a clean stop out and move on within minutes instead of stewing on it for the rest of the day, are almost always the ones who have real stakes and real satisfaction outside the charts. Relationships that don't depend on how the market performed that week. Physical health they maintain regardless of P&L. Interests that have absolutely nothing to do with candlesticks. Not as an escape or a distraction from trading, but as genuine ballast, something solid enough to hold the boat steady when one part of your life is having a bad week. So treat your non-trading life with the same deliberate structure you'd apply to a trading plan, because in a very real sense it's part of your trading plan whether you formally acknowledge it or not. Put training sessions, time with the people who matter to you, and things you actually enjoy on the calendar with the same seriousness you'd give your trading hours. If it's not actually scheduled, in practice, it doesn't happen. Good intentions lose to a busy week almost every time, and the market, being infinitely available and infinitely demanding, will happily fill every single hour you didn't protect in advance. Compare two traders who take the exact same loss on the exact same Tuesday. The first one has nothing else going on that week. No plans, no training session, nothing to look forward to outside the charts, so that loss becomes the entire emotional content of their day, replaying on a loop until the next session opens, priming them to trade the following day from a place of frustration instead of clarity. The second trader takes the same loss, closes the platform, and an hour later is at a scheduled commitment that has nothing to do with the market, a workout, dinner with people who couldn't care less what the S&P did that day. That's not avoidance. It's exactly what allows the emotional charge from the loss to actually dissipate naturally, instead of compounding overnight into the kind of tilt that turns one bad trade into three. Last point, and it directly contradicts the image most people carry around of what a serious trader looks like. The lone genius, alone at 3 monitors at 4 a.m., quietly figuring it all out through sheer isolated brilliance. That's not actually how mastery gets built in any serious field, trading included, no matter how good it looks in a highlight reel. Surgeons train under other surgeons for years before they operate alone. Elite athletes have coaches sitting beside them reviewing film, catching patterns the athlete himself can't see because he's too close to his own habits. Even the traders who present themselves publicly as solo operators, the ones with the big follower count and the "I built this alone" narrative, almost always have a small, quiet circle they're comparing notes with behind the scenes. Isolation doesn't protect your edge the way people assume it does. It mostly just means you're relearning every single lesson the slow, expensive, personal way, instead of also learning from someone else's mistake before it costs you anything at all. So build that circle deliberately, even if it starts small, even if it's informal and just 2 or 3 people. A couple of traders who take this seriously, who you can show your actual trades to, not just the winners you're proud of, but the messy ones you'd rather not talk about, and who'll genuinely tell you when your process was sloppy, even in the specific cases where it happened to make you money anyway, which is exactly the kind of feedback you'll never give yourself. Shared review compounds faster than solo review, plainly and consistently, because you start catching your own blind spots through someone else's eyes, instead of only through your own account balance months later. Think about how differently a review conversation goes when someone else is in the room, even informally. You show a trade that made money, and instead of stopping at the profit, someone else asks why you moved your stop in the middle of it, a question you'd almost certainly skip asking yourself, because the trade worked out, and it's uncomfortable to interrogate a winner. That single outside question can save you from repeating the exact same lucky mistake at a size that isn't lucky next time. None of this requires a formal mentorship or an expensive mastermind. It can be as simple as 2 people trading independently who agree to screen share 1 trade a week, good or bad, and ask each other the questions neither of them would think to ask alone. Put those pieces together, trading in a way that's actually built around who you are instead of who someone else is, interrupting the sabotaging voice with real force instead of gentle reasoning that loses every time, journaling your competence instead of only your failures, repeating one specific change until it's genuinely automatic, protecting a life outside the charts on purpose, and refusing to do any of this completely alone, and you've built something most traders never actually get around to building, a process that survives real contact with real pressure, instead of quietly collapsing the first time a trade goes seriously against you. But there's still one piece we haven't fully connected, the piece that ties the technical rules from earlier in this video directly to the psychological ones we just went through, and it's the part that ultimately determines whether any of this actually sticks the next time you're staring at a red position at 2 in the morning, alone, with every excuse in the world available to you not to follow the plan you set with a calm head. All of this only really matters at one specific moment, the second a trade goes red and your plan is still sitting there, untested, waiting to see if you actually meant it. What happens in that exact moment is what we haven't fully covered yet. So here's where that leaves you. You didn't come into this video needing more willpower. You probably came in thinking the problem was you specifically, some flaw in your discipline that better, more successful traders simply don't have, and you do. What you actually walked away with is something different. The pattern was never a character issue in the first place. It's your brain doing precisely what it evolved to do, weighing a loss almost twice as heavily as an equivalent gain, and reacting accordingly, trade after trade, whether you consciously agree with that reaction or not. Once you can actually see that clearly, the fixes stop feeling like an ongoing moral effort you're failing at, and start feeling like engineering problems with known solutions, the kind you solve once, with the right structure, rather than refighting from scratch every single session for the rest of your trading career. You know the exact moments where that underlying wiring takes over. The pullback that looks like a reversal but usually isn't. The round number that isn't actually structural resistance. the single green candle that isn't actually recovery. You know that a target set calmly before you ever enter the trade is logic, and a target changed mid-trade under pressure is emotion wearing logic's clothes. And you know that a losing trade closed cleanly, exactly at your predefined level, is a genuinely good trade, even, maybe especially, on the days it doesn't feel like one at all. None of that requires you to become a fundamentally different person, which is good news, because that was never a realistic plan anyway. It requires a process built around the person you already are, repeated long enough and deliberately enough that it stops being a decision you have to make in the moment and starts being the default setting you fall back to under pressure. That's the actual shift here. Not fewer feelings. You're going to feel the fear and the hope regardless, every single time. Just less of your actual trading outcome depending on whether you manage to out-argue those feelings in real time. None of it requires perfect emotional control either, which is the part that tends to get lost in trading content built around confidence and conviction. You will still feel that pull to take profit early the next time a trade goes your way. You will still feel the urge to hold a loser one more candle, hoping. The difference now is that those feelings no longer have to be the thing making the decision. The plan you set with a calm head, before any of that pressure showed up, gets to make it instead, if you've actually built the process that lets it. Sit with that for a second before your next trade. Of the traps we've walked through today, which one has actually been costing you the most?